Hey, it's Lawrence here, bringing you another episode on High Intensity Business. And in this episode, we talk about fitness studio tax strategies to increase cash flow. And to help me with this episode, I invited John Briggs back on the podcast. John is a tax genius. He's the owner of Insight Tax and Accounting and author of Profit First for Microgyms. So there's no one better place to talk about how to find more tax efficiencies in your business and drive up cash flow. And in this podcast, we just give you a ton of tips on how you can save a ton of money and increase cash flow in your business. We talk about business entities, what's the right, or how to find the right business entity for your fitness business, writing off expenses, travel expenses, how to write off vehicles, and also managing staff in terms of, do you have everyone as W-2 employees or independent contractors? What are the questions and filters that you go through in order to figure out the best fit for your business? And we get into a lot of the nuances and details in each one of these categories so you can really figure out how to maximize the cost savings and cash flow in your fitness business. After you listen to the episode, please head on over to highintensitybusiness.com/tactics to get access to free resources to help you grow your high intensity training business or fitness studio. Please subscribe so you're first to know when a new episode is published. And of any further ado, please enjoy this fantastic podcast with John Briggs. Lawrence Snell here, and welcome back to highintensitybusiness.com. This is episode 295. And in this episode, we are going to be talking about gym tax strategies to increase cash flow. I'm going to mix up my words there. Today's guest is John Briggs, who returns to the podcast. John is a tax genius. He even has the t-shirt to prove it, and runs Insight Tax and Accounting in Sandy, Utah, a multi-million-dollar firm and the largest in the country, adapting the profit first concept, serving micro gym owners, focusing on tax and cash flow strategies. He has been featured in CrossFit Journal, Box Pro Magazine, and on micro gym podcasts such as Two Brain Radio, WTF Gym Talk, and the 321 podcast, and obviously High Intensity Business. John has been sharing his, you're going to have to update your bio, John. John has been sharing his expertise in fitness business events like the Gym Owners Growth Summit, Profit Con, and Two Brain Summit. His book, Profit First for Micro Gyms, presents a step-by-step plan to help transform micro gyms into profitable businesses. John, welcome back to the show.
Hey, thanks for having me, Lawrence.
Good to have you back. The first podcast was very popular that we did together, and got some great feedback. So I would encourage people, if they're hearing about Profit First or Profit First for Micro Gyms for the first time, then please listen to that podcast to get an introduction to the concept and the book. And I will link to that in the show notes to this one over at episode 295. And I guess what we both decided would be a good topic to cover would be tax strategies to increase cash flow, which I know is something that's of enormous benefit to the fitness business owner. And so I'm excited to dig into this, John, because I know that you're an absolute expert on this topic, and I think there's a lot we could learn. And it's funny because I was reading your book, which I really enjoyed, and what occurred to me is you really don't like the IRS at all, do you?
Did that come across as weird? I felt like I was pretty subtle about it in the book.
So why is that? Do you want to just talk about that for a moment?
There's a variety of reasons. Honestly, some of it comes back to, I don't know if anyone's ever experienced being bullied when they were younger. I did. I experienced that. And so anytime there's scenarios where I can see bullying going on, for some reason, I just have this radar. It's like, that's what I see. I see the injustice of it. And the reality is the IRS is the largest institution legalized bullied. Like it's insane, because the reality is their real job is to help taxpayers pay their legal fair share. That's it. Like if you look at the mission of the IRS on their website, that's what they list. Yet if you ask anybody, how was your interaction with the IRS? You're going to feel like, well, I don't feel like they listened to me. They kind of strong-armed me. They didn't explain things very well. It's kind of like they've moved to this area where they feel they're the enforcers of the law as opposed to helping people pay their fair share. So it's just too many interactions where it's like, dude, that's wrong. Yet most people don't stand up to them.
Yeah, that's a very fair argument. So let's see here. So I want to get into this chapter. So there's a chapter in the book Profit First for Micro Gyms that you wrote, called Gym Tax Strategies to Increase Cash Flow. And I thought it'd be good to just go through this in the same sequence as it has in the book. And so if you want to follow along in the book, you can, or I would definitely encourage you guys to go out and buy a copy, as I think you'll get a massive return on investment. Should we start with the kind of the purpose of this chapter? Maybe it's quite self-explanatory. Do you want to just give a bit of an intro to it?
Yeah, most people don't realize that your largest expense in life is going to be your tax bill. Over the course of your life, even including your house, your tax bill could be more. And so it just stands to reason that we should focus on minimizing that as much as possible. Not to mention, look, the tax code is 76,000 plus pages. And every time there's an election, right, light read, every time there's an election cycle, they add more pages. And it just gets bigger and bigger. And I felt like, if we're talking cash flow strategies and the purpose of the book is to help gym owners increase their cash flow, what better way than to help them figure out how do we minimize the cash outflow for tax purposes, and why don't I just help you narrow down that 76,000 pages into the stuff most relevant for you as a gym owner?
Yeah, I think we're all really grateful for you doing that. And quick side note, a lot of my audience hate the word gym because they think themselves more as a boutique or a studio or a how else might they describe it? Some kind of fitness facility. Now, that doesn't mean we can't say gym or micro gym. I don't want to make this complicated. I just want to apologize to everyone for saying micro gym, but we're going to continue to use that terminology just for simplicity, right? No, that's a great start. And I guess, it's worth saying that before you get to this chapter in the book, you've already opened up all your different accounts. You've got a tax account that you're allocating revenue to. And what we got here. Yeah. And this will basically allow you to make owners pay profit and or OPEX more, which is what you want more in there than you do in the tax column, right? So that's the outcome of this. Yeah.
Yeah.
So I guess, should we start off with business entities? Can we go through all of these? I found this so fascinating. Again, most of the audience are US based. And there'll be people listening to this who are maybe thinking about starting a micro gym or HIIT studio in my case. And so they'll want to know which structure is best for them. And maybe there are some people listening to this who have a sole proprietor business and they want to move to an S Corp or something. So do you want to start with sole proprietor and talk about the pros and cons? Yep.
Yeah, and let me also go back to the most basic. When we talk entity, it's a legal word. It's really just talking about the structure of which you choose to do business from a legal standpoint. And then the IRS comes in and said, hey, based on that legal structure you chose, these are the different ways we're going to tax things. So we're really just talking about your business. I wish there was a better word that the world created, but unfortunately entity is it. It sounds, not very human. So a sole proprietor is really, you basically are saying, this is the name I want to be known as, but treat me like an individual. And the IRS then comes in and says, okay, great. So you're a sole proprietor. The way you're taxed is all of your income is going to be subject to self-employment tax. Now, in the US, self-employment tax is also called FICA, FUTA, SUTA. Sometimes you think about just the generic term payroll tax. All of those different words are really just referring back to this 15.3%. Now, if you have an employee, the employee pays half of that 15.3%, and you as the employer pay the other half. In this case, as the business owner, you have to pay both, which is why it's 15.3%. This is the worst tax structure ever because it's basically not a structure, and the IRS gets the most out of these. So we've had clients, they might net $30,000, which is a relatively low tax bracket. But then you add the 15.3% self-employment tax on top of that, which is more than their income tax rate. They can easily be in the 30% tax rate at $35,000, which is just, I mean, I throw up in my mouth when I think about somebody paying that much in taxes. So that's the sole proprietor scenario. We strongly recommend to never use that.
And just question on that. So you got the high taxes that you mentioned. There's also a high, I think you mentioned in the book, there's a high chance of an IRS audit as well, right? Which is not fun.
So if you Google search this, you'll find any number of thousands of results confirming this response. But the IRS, they audit roughly like 1% to 2% of tax filers every year. But what they don't like to highlight is of that 1% to 2%, a high percentage, more than 80% of those people audited filed basically a sole proprietor. So your sole proprietor gets filed on a Schedule C, which is a huge audit trigger when it comes to what the IRS is looking at to determine, hey, who should we look at to get more money back?
And do you come across a lot of gym owners, studio owners who are sole proprietors who shouldn't be, or is that more unusual?
Yeah, actually, because you have like the fitness professional studio owner who maybe has a structure underneath, but then maybe they're paying their coaches as independent contractors. Well, that independent contractor is a sole proprietor unless they do something to be classified differently. So there's probably a lot of fitness professionals who are coaches out there that may not have like a full-fledged brick and mortar location. Maybe they travel to their clients, maybe they do out their garage, that likely are overpaying in taxes because they're being taxed as a sole proprietor.
Now, I know we're going to cover this in the separate entities, but could a contractor move to one of these other entities to be more tax efficient? They can. Okay.
They
so maybe
can.
We'll cover that when we move on to the next entity.
Yeah.
So is it prudent to talk about single member LLC now?
Yeah, it is. So single member LLC is simply saying you set up an LLC. So you took a little bit of a step to be not a sole proprietor. And because there's a single member, it means you own it 100%. Unfortunately, the default tax outcome of a single member LLC is to be taxed like a sole proprietor. So all the single member LLC does for you, if that's the only step you took, is it gives you some liability protection that you don't have as a sole proprietor. But other than that, everything else stands the same. You're paying a crazy tax rate because of the self-employment tax affected on all your taxable income, and your audit risk is the exact high audit risk as a sole proprietor.
Are there any circumstances where it is ideal to be a single member LLC, or is it just the better options, better alternatives?
There are a few scenarios. We have some tax strategies about like paying your kids or a medical reimbursement plan. There are scenarios where you can set up an entity as a single member LLC for strict tax purpose strategies. But in those cases, it's filed in a way where it's not increasing your audit risk. And then I'll go back to the last concept of a single member LLC when we talk about S Corps, because it makes more sense in that light.
All right, so now we're at multi-member LLC.
Yeah, so this is, you set up an LLC, but now instead of just you being an owner, there's at least one other owner. So it could even be 99.9% and someone else owns 0.1%. You now have more than one member, therefore it's a multi-member LLC. These entities are a little bit better from audit risk standpoint because it's a separate tax filing, right? As a sole proprietor or single member LLC, all of that information is filed on your personal tax return, which is one of the reasons why the audit risk is so high. But as a multi-member LLC, you now have a separate tax filing for your business, which reduces the chance that your personal return gets selected for audit. However, you, as an active participant in running your business, you are going to still be subject to that self-employment tax of 15.3%. And sometimes when I say that, some people are thinking like, well, it's good to pay into the Social Security system and things like that. Look, if you believe that, that's great. I don't. And that's why I push so hard to minimize that tax as much as possible. I think anyone under the age of 55 is probably not going to get as much benefit out of that system as they think. And it potentially is going to be bankrupt by the time you get to that point. I also personally don't want to live my life in a way where I have to depend on the government to provide some sort of retirement to me. And so I want to reduce how much I pay into the system as much as possible. Mm-hmm. And so while the multi-member LLC reduces my audit risk, I still am going to pay a crazy tax rate, just like I would as a single member LLC or sole proprietor.
Okay. Let's see here. Okay, so you mentioned IRS audit less likely. You said about how a passive, in the chapter, you said about how a passive owner will pay less tax. So there is potentially some tax breaks to be had in that entity. Is that not right?
Yeah. So if we've seen this, at least with gym owners, I don't know how that works with HIT studios. I'm assuming it's the same. Sometimes
it's the same. It's the same. Yeah.
Yeah. So you'll have the guy who's the technician, the super passionate about the actual fitness component of the business, but he might not have the capital to open it up. And then there's someone who believes in him. And they're just going to come in as an investor. They're not going to participate in the day-to-day. They're not really the fitness expert, but they're going to be a business owner because they contributed money towards the operations. They can totally have ownership in a partnership without worrying about self-employment tax, because the IRS, the self-employment tax is tied to this concept of ordinary income. And if I'm an investor, any income I'm taxed on from a passive investment is not considered ordinary income. It's considered passive income. So passive income doesn't have this self-employment tax crap tied to it.
Okay, cool. So now it's I guess time to move on to the S Corp, which I think is your favorite, right?
It is my favorite for fitness professionals, without a doubt. If your net income, so if we consider revenue collected from members minus your expenses, if your net income is going to be $10,000 or more a year, the S Corp is definitely something that needs to be in your tax structure. The reason this works is because the net income of an S corporation is not subject to self-employment tax. So that 15.3% that we've been talking about on all these other different entity structures is not going to be applied to your income if it's run through an S corporation. Now, this is where it gets complicated, and unfortunately, this is sometimes where fitness professionals may say, well, that just seems really complicated. I'm not going to go down that road. And even sometimes when you talk to an accountant, believe it or not all accountants are created equal. And some of them don't like doing business returns, mainly because they haven't spent the time to figure out how to do them. But the S corporation has a little complicated component, which with a competent professional, they'll handle all that for you, so it's off your plate and you get the tax benefit with, stress-free. The IRS looked at this and said, hey, wait a minute, you guys aren't paying self-employment tax on this income. What can we do? There's got to be something we can do, right? Bullies, remember? So how can we bully them a little bit more and take more of their money that is really better used by them instead of us taking it and blowing it on stupid stuff? They said, okay, if you're an S corporation and you're the owner and you work in the business, we're going to make you pay yourself a W-2. You have to give yourself a W-2 out of your business. With all the other structures we've talked about, sole proprietor, single member LLC, multi-member LLC, you're not required to issue yourself a W-2. However, with S Corp, you are. So now you have to run payroll. Payroll, I don't want to run that. That seems complicated. Well, I promise the tax savings are there. And this is why, is because the IRS says this W-2 you have to give yourself out of an S Corp, it just has to be reasonable compensation. That's the word they use, but they don't tell us what that word actually means. There's no definition. Reasonable, what's reasonable? My definition might be a little bit different from the IRS. So people like me, we've gone through all the different court cases where people have tried to get by this and the IRS came in and bullied them. So now we have kind of how judges have ruled, because they're the ones who actually interpret the tax law, not the IRS, how they've interpreted the term reasonable. Well, you will never have to pay 100% of your business income in the form of a W-2. And the reason that's important is because you do pay the payroll tax, this self-employment tax, that does get paid on the W-2 amount. But it's never going to be 100% of your net income. So always you're going to pay less self-employment tax by having an S corporation, even though you're going to have to give yourself a W-2. Again, if you have a competent accounting professional, they'll take care of all this for you. Like, you don't even have to think about, oh man, when do I need to file? And am I filing the right dollar amount? Let them handle all that so that you're compliant with the IRS and you get the tax savings. Because other than that aspect, having a partnership or an S corporation, it's all the same. You still got to keep your bookkeeping. You're going to have to give it, you either do it yourself or give it to a professional. You're going to have a profit and loss statement. You're going to have bank accounts. Like, everything else is the same as far as running your business. The only difference with the S Corp is you have to give yourself a W-2.
Okay, yeah. And just a side note, your book, Profit First for Micro Gyms, one of the things I really like about it is you definitely wrote it for that audience, right? In terms of even the chapter names are related to diet and things like that, fitness. And you're very good at keeping it high level and so that, you know, people's eyes don't glaze over and they can actually absorb it and implement it. And you're very self-aware about how boring some of this stuff can be to certain individuals, especially in the fitness industry. But to kind of underscore your point, obviously it makes sense for us to outsource this to tax and accounting firms. And I think obviously we'll have your details for people if they want to learn a bit more about what you do, as I think you're a good fit for a lot of my audience since you specialize in working with, you know, fitness studios and micro gyms and that kind of thing. Okay. So let me just want to make sure we covered everything here. So you mentioned you're paying less tax than multi-member LLC, any other options. Probably the optimal way for micro gyms to maximize tax savings. You talked about how to set the reasonable wage. Do you want to just describe W-2 versus distribution, just so people get an idea of how to pay themselves?
Yeah, because this can get confusing.
Obviously, try and keep it high level if you can.
Yeah, well, even with our accountants, like, it'll take them sometimes some months, new accountants, to understand this concept. The reality is, if there's money in your business bank account, you can pay that to yourself. And if you have a competent accountant, they will make sure that everything's filed the right way. So ultimately, that's the overarching theme here. You don't need to worry about the nitty-gritty per se, but let me just give you a little bit of what it means. The W-2, there's payroll tax filings that go with that. And so technically, you would want to show, if I pay, just like you pay an employee, let's say I pay him $1,000, he's going to get $900-ish deposited into his account after payroll taxes and all that crap. So he sees a $900 deposit. That $900 came from your business account. Well, in this case, we're just saying, instead of it being another employee, it's you personally. So if you paid yourself $1,000 in a wage, a W-2 wage, you'll see a $900 deposit-ish into your personal account. Then the other money that you live off of, because you definitely aren't going to live off of just your W-2 amount, because our goal is to get that amount as low as possible, not, hey, you should get this as low as possible and live off of it. That's psychotic.
So you're almost tax efficient, right? But,
right. So you're obviously going to pay yourself more out of the business. In that case, give it to yourself as a distribution. And that's as simple as just doing a bank transfer or writing yourself a check from your business. Just transfer the money from the business account to your personal account, and having a competent tax professional, they take care of all the other aspects to make sure everything's getting taxed the right way.
Is that the same as a dividend distribution? Is it just a
Yeah,
synonym to dividend?
dividend, distribution, shareholder draw, owner's draw, owner distribution, all those terms are the exact same thing. It's just the
Yeah.
business are taking money out of the business.
Sure. And then when it comes to the dividend, my understanding again, I'm a Brit, so I'm ignorant about a lot of laws in the US. But there's obviously different tax bands in different states, right? So I understand that Texas is quite attractive for low corporation tax. Is that right? So that dividend
Yeah.
would be taxed differently depending on where you are in the US. Or
Um,
sorry, distribution. Is that correct? Or
yeah, so that's the difference between federal and state. So you have in the US, you have federal taxes you pay, and that dividend distribution, that's going to be taxed across the board the same way federally for anybody, regardless of what state they live in.
got it.
But there are some states that don't actually have state tax. So that in this income tax, I should say. So Texas doesn't have income tax. Florida doesn't have income tax. There's a few others.
Mental note, that's where I moved to.
So like with Texas, it's favorable until your business does more than $1 million in revenue. Then they have this franchise tax that they make you pay. See, that's the thing. Like they may not have income taxes. All these states who don't have income tax, they have another tax. They're getting that money somehow. So in Texas, it's in the form of a franchise tax for businesses that do more than $1 million, and they have much higher property tax than other states. Other states, they have a much higher state sales tax, for example. But yeah, so the point being, if you're under $1 million and you're looking to move state somewhere, Texas isn't a bad state when it comes to income tax purposes. In fact, side note, LeBron James was with the Cleveland Cavaliers, and then he went to the Miami Heat, right? Well, when he was debating between the different teams, now I don't know if he was ever quoted on this. I'm just looking at it from a tax standpoint. I'm sure whatever financial team he has, they said, hey, look, here's the deal. If you go to the Knicks, you're going to pay this much in state taxes, which is in New York and New York City, which, by the way, is one of the worst tax areas to be in. Or you can go to Florida. And because Florida doesn't have a state income tax, you automatically save like millions of dollars a year just by living in Florida and having the majority of your games in Florida. I am willing to bet, because he was going to drag those other superstars with him wherever he went, I'm willing to bet that had an impact in his decision on which team to choose from.
Yeah, that must always play a big role in where they decide to move to, because when you're talking about that level, that amount of money, the savings are enormous, right? I remember seeing a comparison between, I think it was James Harden, and I love that we're talking about basketball because I have an interest in basketball. And they did a comparison between James Harden, who I think was at Houston. I haven't followed it in the last year, to be honest with you, and Stephen Curry. And I think it was James Harden was earning, yeah, exactly right. So where it's very high tax band, right? Yeah. And James Harden was earning significantly more than most of the other top 10 players in the league. Obviously, he is one of the top, if not one of the top 3, let's say, at that time. But he was earning we're talking 10, 20 million more in his NBA contract just due to location. From memory, I mean, I'm just guessing.
No, that's totally accurate, because Houston's in Texas. Yeah. So as an individual, he's not going to have income tax, and California has the highest as far as I know. And they're actually, man, if you're listening to this and you're in California, you legit need to consider getting out of that state.
Well, they are. A lot of people are moving, aren't they? They're moving across.
Yeah. I have a colleague in Los Angeles, and she said, dude, there's moving trucks all over the place. You can hardly drive anywhere. But they're looking at doing a tax. They're going to increase the state tax, but then they want to be able to retroactively apply it to past years. It's hey, we're going to increase your tax, and by the way, the income you made 2 years ago, we're going to make you pay this higher tax rate on that, so you owe us the difference.
Wow. Yeah.
It's never been done before. But
yeah,
hopefully the people vote that down. That's just crazy to me. Taxes,
I would agree.
Really, like I said earlier, it is your number one expense over the course of your lifetime. you want to minimize it as much as possible. And looking at state tax rates is one of the ways to do that.
Yeah, I appreciate the advice. And I guess moving on to the next entity, C Corporation. Do you want to just describe that and your thoughts?
Yeah, so a C Corp, unlike the S Corp and the partnership, which has a separate tax filing but doesn't pay tax itself, you're taxed individually on your net income from those businesses. The C Corporation is a separate taxable entity, which means it as a corporation pays a corporate tax. Now, if you want money out of the business, which you do, we all do, you then have to pay income tax on money that was distributed to you from the corporation. So we call that a double tax because you've paid tax once on the income at the corporate level, and then to get it out of the business account to your personal account, you have to claim it as income on your personal return and get taxed again. The only reason you would consider a C corporation is if you have massive plans for multiple locations, potentially a franchise type of thing. You're dealing with big equity money.
Got it.
And those guys are just more comfortable with the C Corp structure where you're not worried about the tax stuff because these guys are actually funding most of it and you're hoping for a big exit. But for my world and the fitness professionals we deal with, that's never the case.
So what a lot of the big organizations in the US, are they mostly C Corps then? You know, like the Facebooks, the, Apple, like the big kind of organizations?
Yeah. Mm-hmm.
Yeah. Okay. Got it. And what if someone's listening to this and they're hearing what you're saying? They're like, oh, maybe I need to move to a different entity. How easy is it to switch entities?
It's fairly easy. Most of the time, there's a 1 or 2 page form you file with the IRS, depending on which way you want to go. It says, I was taxed this way, and I want to be taxed a different way. So a lot of times, you don't even have to set up a new business structure at all. Of course, I always recommend running that by your attorney, and just in case maybe they need to update some of your corporate docs. But no, it's fairly simple. You don't have to change your bank accounts either. So it's pretty simple.
Okay. And that doesn't matter what entity you go with. It's fairly straightforward regardless.
Yeah.
Yeah. Okay, cool. So let's talk about, and this is, I suppose, more interesting to people probably, what can I write off? So do you want to talk about that and talk about the filters that you use? You have quite good filters in the book, like good questions to ask yourself when looking at expenses, potential expenses.
Yeah. Here, the tax code uses the word ordinary and necessary. So it says in order to claim a business deduction, it has to be ordinary and necessary. And then people are like, well, that's not very clear to me. So then they come up with, hey, we'll clarify it with more words. And so anyways, the way I summarize the jargon and crap the IRS spews out to us is this way. If you're spending $1 and you can tie it to your business in any form, shape, or fashion, you can write it off. And you should pay for it out of your business account. It's that simple. Like just whatever I'm doing, I'm going to the store. Is this purchase tied to my business? Yeah, okay. Well, I should claim the miles that I'm driving to the store, and I'm going to use my business account to cover this. We want to take a family trip. Okay. How can I make this a business trip before I actually go on it? What can I do? Just, is it tied to my business? And with fitness professionals, especially with travel, I think that's one of the topics, so I'll probably just spoil it right now.
That's
but
okay. Yeah.
It is so easy to come up with reasons why a trip can be business related because so many people do things just a little bit different or a lot different. And as a fitness professional, maybe you just want to go experience that. Research and development is a type of business purpose. Mm-hmm. So if I want to go to Southern California where there's Disneyland, there might be some fitness studios down there that I just want to check out because I'm curious if there's anything I can take from their studio and apply it to improving my business. Boom. Business purpose, business trip.
But you've just gone for a workout, basically.
Yeah.
Before you've gone to Disneyland
uh-huh.
for the day. Yeah. Yeah. I love this. This is something that I just think, as someone who was an employee and, from my old life, I was in sales in London, and then I, became business owner, moved to Ireland to live, and immediately started to take advantage of the efficiency benefits of owning your own business over being an employee, or PAYE, as you would say in the UK, and just being able to write off everything related to the business. And it just came natural to me to ask, well, say it comes natural. It was my accountant helped educate me, but it was just to ask that question at every turn, right? Is this, related to the business? And I mean, my situation is quite different to the studio owner. I mean, I have a studio, but my primary business, obviously the online, the podcast, the website, which it starts getting really crazy because you can almost associate practically any expense with that type of business. That's a separate conversation, which maybe one for another time. But on this vein, this is cool because you basically said that, talking about travel expenses, like almost any travel you do ever with your family, you go on vacation, anything like that, there can be some kind of justification you can do to claim that travel, and claim not only the travel but the accommodation, the subsistence, fuel, fill in the blank, right? So, but then in the book you say you have to pre-plan this.
Yeah.
Now, can you, because that confused me a little bit, so can you just talk about that a bit?
Yeah, so that's related to the IRS. A lot of times when I look at what can we write off, I also have to figure out, okay, if we happen to be audited on this scenario, are we going to have enough proof, evidence, compelling reasons as to why this was justified? Because if you don't, they love to throw out the fraud word. And so you just have to have a good reason why you did it. So based on their rules, you can't just like go to the restaurant for your personal purposes and then, I'm going to strike up a conversation with a random stranger, like maybe my waitress or server person, and then say, hey, this was a business expense. They have to say, no, you scheduled a meeting with the server and that's why you went. So it's the same concept with travel. I can't just go to Southern California, do a workout at a gym close to Disneyland and say, boom, business purpose. I'll need to prove that the reason I went down there was to actually do the workout. The other stuff that I do outside of that just happens to be really fun, and I took my family with me. So that's why the pre-planning function is really important. But that can be as simple as you email the gym that you want to go check out, and you save your email. Doesn't necessarily mean they even need to respond, or you need to have to save that. Like, just showing enough evidence, like I thought through the business purpose of this trip before I took it. For sure, from our standpoint, we're saying like, okay, if I have a family member or some wedding I need to go to in a different state, okay, I want to go there, but how do I make it a business trip first? And how can I show that that was the reason why I booked my ticket? It just so happens it's convenient that my friend is getting married at the same time that I'm visiting that gym or fitness studio.
It's a bit of a curveball question for you. So what if, if you have a team of people and, for instance, you talking about this, John, would suggest that this is something that obviously you take advantage on in your own business. But unfortunately, depending on how you look at it, our teams, our employees can't take advantage of this as much. And maybe you would argue, well, I'm the business owner, I'm taking all the risk, I'm giving you a job, therefore this is one of the perks. Maybe that would be your answer. But how do you feel about that? If someone's listening to this, maybe they've got a team of 20, 30 trainers, and they don't want to have that perception from their team of, this guy is actually spending a lot more on personal, there's a lot more personal income that is actually on the accounts here because he's doing all this other stuff with revenue. So what's your mindset around that? How do you think about that?
Yeah, so this plays in nicely with the profit first system, actually. So one of the bank accounts we want people setting up is the owner's pay account. And that owner's pay account represents money for the benefit of the owner's day-to-day living expenses. And so, like in these situations, you have a percentage that the profit first system is based on percentages, right? That way it doesn't matter how big or small your business is. You use the percentage so that it makes sense. And if I say have a 15% percentage for owner's pay, I'm going to go in and I look and I can see, oh, these last 2 weeks I took a business trip, but it was really my family going to Disneyland. So I'm going to take advantage of the tax code and still get a write-off. But from a profit first standpoint, I do look at that as compensation to me as the owner. So my distribution that month or that period is going to be less than what it normally is because I've already spent it. I've already used some of that compensation in the form of taking a business deduction.
Cool. Yeah, I love that. I love tying it back. That's awesome. So, okay, is there anything else? I guess just to complete this piece about what listeners can write off in their business. Are there common items that you see in your clients or in people you talk to who they're not writing these things off and they should? Is there anything that comes to mind?
Man, it's never one thing. So we always tell clients, especially new ones, hey, it would be worth your investment to go print off or look through all your personal credit card statements and your personal bank accounts and personal credit cards. If you look through those two things for the last year, with now this in mind, like, was this tied to my business? Let's make sure we're claiming those as deductions because it is completely random. Sometimes they're like, oh, yeah, this charge here to the grocery store was actually for a team meeting. But you forgot to use the business account. Okay, well, make sure you capture that. Cell phones, for example, sometimes people get, I don't know why, weirded out. Like, I know it's your personal cell phone, but you have to be reachable by all your members and all your clients. So that's obviously a business expense. Home internet, I mean, you can't do anything nowadays without the internet. And if you're like me, which most of our clients are, and I think fitness professionals are, you're kind of working constantly, or you're at least always thinking about it. So, I mean, the IRS, if you're audited and they say, hey, you wrote off your home internet as a business expense, I would say, yeah, if I didn't have a business, I wouldn't have internet at my house. They can't tell me that's wrong. So, therefore, I have home internet expense because I am in business and I need to be able to use it for business purposes. So there's not a general one that across the board fitness professionals are missing. It really is just pretty random. That's why I always just recommend go through the statements. If it looks like it's tied to your business, you're probably going to remember it was tied to your business, and we want to make sure we capture that. Pay the least amount of tax as possible.
Yeah. Awesome. Okay. Now, what about writing off my car or truck? Do you want to just intro this section?
Yeah. This is, it's actually fairly straightforward, but for some reason, there's a lot of misinformation out there. So I think people usually when they're approaching me with the question, they're always coming to me with some sort of misinformation. You can write off your vehicle. If you're using it for business purposes, there's a way to write it off. And the IRS has narrowed it down to two ways. You either can write off the actual expenses that you incurred in using your vehicle for business purposes, or to simplify it, if you can track your miles, they have a mileage rate that they change every year. Whatever that mileage rate is, it's multiplied by your business miles, and that's your deduction. It's one or the other. You can't do both. But where they get you is they say, well, with your actual expenses, we have to know how much of a percentage of those was really business, because obviously they always assume that you use your vehicle for personal purposes as well. So you have to prove, the burden of proof is on us as the taxpayer. You have to prove to them how much of the business or how much of the vehicle is business use versus personal. The singular way the IRS asks you to do that is by keeping a mileage log. There's no other way. So whether you're taking the one method of what you actually spent on the vehicle or the mileage rate, they're going to expect a mileage log from you. You got to do it. Nowadays, there's so many apps out there. The common one that our clients use that I see is called Mile IQ. I guess it's like the Tinder for mileage log tracking. Like swipe right if it was business purpose, or swipe left if it was for personal. And then at the end of the year, you just print off your report and give your accountant.
Okay. There's also a really good diagram in the book on this, if I remember rightly. I'm just going to...
Yeah, we did a decision tree type of thing to reflect, look, this is kind of complicated, but it at least walks them through so that the reader can determine which method might work for them. And if they are going to use which method, what's going to be involved in that.
Yeah. So yeah, decision tree, as you said, like an if this, then that flow chart kind of thing.
Yeah.
Which I think is really effective if people want an illustration to highlight what John's saying. Awesome. Okay. So do you want to go on to just talk about the bonus questions, vehicle title, and wrapping the vehicle with a logo, those nuances?
Yeah, this is some of the misinformation out there. Some people feel like, oh, if I have a vehicle and I want to write it off as a business, it needs to be owned by the business. That's not true for tax purposes. You can have your vehicle titled in your personal name and still take a deduction for your business use. And the challenge that people get into if they make that mistake of, oh, I titled this in my business name, they often don't get the business insurance policy on it. They still have their normal personal property and casualty coverage. And not a shocker here to anybody, but guess what? Insurance companies don't want to pay out claims. They want to take your premiums, but they don't actually want to pay anything out, which is why, I mean, it's evidenced by how freaking hard it is to get a claim to go through, and they just put you through the ringer and feel like you're on trial. They are going to find out. They're going to see, oh, you have a personal policy on this, but it's titled in your business name. Therefore, your insurance coverage doesn't actually cover this vehicle. But thanks for your money. We're not going to refund it to you. So if you're going to go that step, I always just recommend you probably want to have multiple vehicles, a fleet, to justify going through the headache of getting a business insurance policy on your vehicles. And so instead of that doesn't fit the bill for fitness professionals, don't worry about it. Buy it in your personal name. You can still write it off, and a competent accounting professional will help you maximize the tax benefit of that use without you going through any sort of headache stuff when it comes to titling it in a business name and the insurance policies and all that. The other component was, sometimes people feel like, well, if I'm using it for business purposes, I have to put my business logo on it. I got to wrap my vehicle. I got to get some sort of graphic design on that. And that also is specifically listed in the code and in the IRS rules as not a requirement. So if you think wrapping your vehicle is going to increase your business revenue and your profitability, then go ahead and wrap it. That's a good investment if you think it's going to work. Do not wrap it because you think that's the only way to write it off. There is nothing on my personal vehicle that has any sort of indication of my business logo or anything, and I claim it every year. So you don't have to do those extra steps.
Awesome, thank you for that. Maybe we've already covered this. How do I write off equipment expenses? Do you need to elaborate on that at all?
Yeah, we didn't talk about it. So this one just comes down to most fitness professionals are like, oh yeah, obviously it's equipment, it's business, I'm going to write it off. But they get confused if they borrowed money to buy the equipment, right? So I might borrow $30,000 and buy a bunch of Rogue equipment, and I have this loan now to somebody who financed that. I can still claim the full $30,000 of equipment as a tax deduction that year, even though I'm going to be making payments in future years to pay off the cost of that equipment.
Most people don't realize that because it's not money.
They just get stuck. Yeah, it sticks them a little bit.
Yeah. Okay. Fine. Now, I suppose it would be probably ideal to spend the last part of this just talking about how do I classify my coach or team as this is probably one of the more nuanced and complicated parts. So I guess we'll do our best to try and cover this one in the time given. So do you want to just intro that and we'll get into that one?
Yeah, I mean, the intro to this is there's just a lot of misinformation about how you pay your coaches, if they should be an employee with a W-2 or if they should be an independent contractor for 1099. And unfortunately, a lot of this misinformation is coming from people who aren't accounting professionals. So I'm just trying to right the ship here, because sometimes people say they should always be employees or they should always be independent contractors. And as you can imagine, with 76,000 pages, very rarely does the word always apply to anything when it comes to taxes. And so I just tell professionals, if your coach is a legit independent contractor, then you should pay him as an independent contractor. You shouldn't buy into this idea, well, they have to be paid a W-2. Because again, from a business standpoint, cash flow, what we're talking about, if they're a W-2 employee, I basically am going to pay 10 to 15% on top of whatever their wage rate is, because that's payroll tax and unemployment insurance and workers' comp. Those are all additional business expenses that I have. Now, I'm not saying pay your coaches this way just so you can save money. You have to follow the rules. And the IRS has 24 rules, which we won't go into all 24 of them. Because that would just, if you are that interested, maybe in the show notes, you can resource. It's a checklist that people can go through everything if they want. But just the idea being, make the right decision for your gym. The only caveat I have to that is California, at the end of 2018, passed a law that basically said if it's the primary service of your business, the person has to be paid a W-2. It is still currently being fought because it's a ridiculous ruling, but it is what it is. So as of right now, as of 2020, your coach as a fitness professional, your coach is going to be a W-2, period. Actually, even with period, there's an exception. Let's say you also provide nutrition services. You could probably pay that coach as an independent contractor for the nutrition component of the work they do for you. But certainly doing the sessions with your members, that in California, that's always going to be W-2. Okay, so that being said, that's why there's a big thing. Some people feel like the business owner is being dishonest, or even myself, I'm trying to help business owners be dishonest by forcing them to classify all their coaches as independent contractors because the business saves money on that. The reality is the coach also benefits because they can now apply the 76,000 pages of tax code to their situation, and they can start writing off the personal travel. And there's a bunch of stuff benefit there. So they end up paying less in taxes too. But a lot of times, sometimes coaches are just like, that feels complicated. It feels like you maybe are trying to screw me. So always good to have a conversation with them about the tax structure either way. At the end of the day, W-2 versus 1099 comes down to control. How much control are you putting upon your worker? If you're putting a lot of control on them, demanding when they actually come in, telling them exactly how to do their job, providing equipment to them, things like that, that makes them a W-2 because like you're basically bossing them around. If you're saying, hey, you can choose which classes you want to coach, you can choose to work out with these different members when their sessions are, we can build in some sort of rental rate where maybe you are renting space from me, you pay for your own training, those types of things, your certifications, they could be independent contractors. Mm-hmm. But it really, those 24 points, for the most part, come down to control. Obviously, if you're audited, the state and the IRS want them to be classified as an employee. And so that's why people are a little afraid of it too, because that seems to be the focus. But we've helped, and in the book I talk about some of the cases where we've helped gym owners who had independent contractor coaches. They went through an audit with the IRS about, hey, and the state, hey, this guy should be an employee. You owe us all this back payroll tax. And we won. Like, no, we can prove that they're independent. They're independent contractors, and we won. So I know for a fact that you can have a coach as an independent contractor, but at the end of the day, as a gym owner, you, as a fitness studio owner, fitness professional, you have to choose how much control you want and what you're willing to give and not give. And it's not, if you want ultimate control, fine. That's not a problem. Pay them as a W-2. It's okay. It's not the end of the world. Yeah. But if you have some ability to have some flexibility, it is better from a financial standpoint if they can remain independent as an independent contractor.
It's better for them, not for necessarily for you.
It's better for both. It's a win-win. You pay less in payroll tax as the owner, and then they can take advantage of a bunch of deductions they don't get anymore as employees.
Yeah, it's difficult, isn't it? Because I'm thinking about the studios that I know, the business that I know that I speak to, and I think one of the challenges is like you were saying about control. It's like, I think it's quite well known in business that if you can get a group of people all rowing in the same direction, pursuing a similar vision, consistent in their approach, that kind of real kind of team ethic, that's something that's pretty important for growing a successful business. And when you've got independent contractors, people who are maybe less invested in that vision and being part of this kind of having this unity and being part of this vision, it's I think, correct me if I'm wrong, but I think that's you're less likely to have a successful outcome over the long term in growing your business. So there is a downside, obviously, in terms of tax efficiencies for both parties, but in terms of overall business success, maybe the W-2 is a better route for most. That's my opinion. And I do know a couple that have contractors, but the ones that I know who seem to be the most successful, generate the most profit in our industry tend to have employees for the most part. What do you see? Yeah.
I don't know. I think I see it a little bit differently. We have hundreds of clients who have coaches as contractors. To me, I think it comes down to the owner's ability to properly share his vision or her vision with what they want to do. I've seen independent contractors all get in the boat and agree to this vision.
Okay.
They like it.
So it's not mutually exclusive then necessarily.
It's not. Like, so in our gym, for example, when I bought into it, and I highlight some of my failures in the book itself, but I bought into a failing gym. It wasn't profitable. And when I joined, they had like 13 coaches, and they're all part-time, and they're all independent contractors. And so within a couple months, we shaved that down. It's like, it's way too many people. Because what you're talking about, for sure, the previous owners, the leadership, the vision hadn't been shared in such a way where the others bought into it. And so they were all rowing in different directions, their own directions, and many were in their own boats, and it was bad. So as of right now, after 2.5 years in my gym ownership experience, my micro gym owner experience, we have a full-time GM. Now, because he's full-time, and there are specific things we want him to do, he is W-2. All of our coaches are independent contractors, but the current coaches have bought into what we're trying to accomplish in the gym. And so I know that as they choose to do certain things, even though they have flexibility, that they're doing it in a way that matches what we want. And if they don't, even though they're independent, I have the right to find someone else to replace that person. Yeah, so in our gym, personal training sessions, they coordinate with the client on what works best for them and the client. We're not involved at all. When it comes to scheduling, they're the ones saying, this is the class I'd like to teach, and if they can't make it and they need someone to fill in, they're taking care of finding someone else to replace it.
Yeah, so that's a great filter right there.
So they're really independent.
Yeah, because I'm just thinking
in our studio.
Sorry to interrupt you, John.
I was just gonna, yeah, it's fine.
No, that's a great filter, right? Because I know there's plenty of organizations in, people that listen to this who do want to have that centralized scheduling, right? And so it might be in their best interest not to have contractors in that space, in that case, sorry. And maybe you cover it in those 24 questions as a way to figure out what's the best fit for your organization. That's kind of what you were saying, right?
Exactly. So,
Okay.
and just so you know, the IRS is never going to come in and say, "Oh, you're paying all your coaches as employees. You know, we really think they're independent contractors." That's never going to happen because that doesn't benefit them.
Mm-hmm.
So, what I point out in the 24-point checklist is if you're looking to have your coaches independent, here are things based on each point that will make them independent, and here are things that are for sure going to make them employees. If you want to make your people in W-2, if your coach is W-2, you don't need to spend time on this. The IRS is never going to come and say, hey, they're actually independent contractors, but thanks for all the extra payroll taxes you've paid in. You know, they're not going to refund that. So they don't care. So if you want to go the W-2 route, you don't really need to worry about any of this stuff. It's more of if you feel like there's some area to give them some more flexibility and you're willing to take that trade-off. That's what the checklist is designed for.
Awesome. So just on this point, if people want to dive into this even more, there's a really good podcast on the Fitness Business Podcast. So here I am promoting a competitor podcast with Sherry McMillan, who is the owner of Northwest Personal Training. She's a very impressive woman and done really well in the fitness space, and now is kind of also in the fitness education space and does some other things too. And she did a whole podcast with them on this exact topic, on contractors versus W-2 employee. And I'll link to that in the show notes of this over at episode 295. So you can listen to that one to do a deep dive. And then I'm sure, as John was saying, there's more in the book and there's 24 questions you can go through as well. John, we come to the end of the episode. I want to obviously be respectful of your time. What's the best way for people to find out more about you and move forward with the different things you have to offer?
The book is great. It's on Amazon, and obviously it's selfish of me, but I do think it's probably going to be a really great return on a $20 purchase. You're going to get at least one golden nugget out of it that's going to
for sure
affect your cash flow in a positive way. ProfitFirstForMicrogyms.com is a great place to kind of check us out as far as it comes to cash flow stuff. And then, of course, our tax firm itself is InsightTax.com. We have a lot of resources available to help fitness professionals. Ultimately, we've narrowed in on the fitness world because I think it's the most important industry that exists in the world. It can move the needle of a lot of different problems that exist just by people participating in the services that you offer. Like, you literally are the heroes of humanity, and you help people have better quality of life, everything. And so I just felt like, if I can make a fingerprint or some sort of impact on the world, it's to help the real experts, the fitness professional experts, stay in business as long as possible. So we try to provide as many resources as we can to help fitness professionals. And of course, we have a Facebook page, Profit First for Microgyms. I try to get on once a week and give some tips. And then, of course, we have other stuff, and people can interact and ask questions with each other, all things cash flow related. So we're just here to support the fitness professional any way we can.
Awesome. And it's Insight, spelled INCITE tax.com, in case people start typing in Insight with SIGHT. So INCITE tax.com. And I highly recommend the book. I've read it. I think it's done in a way where you've shown a ton of empathy for the fitness business owner. I think this podcast might have introduced Profit First as a concept to certainly my niche, the high intensity training studio niche, for the first time for a lot of people. And I know a lot of them have it on the agenda to implement. And we'll probably be doing the same here in our studio at some point. And so that's quite exciting. And obviously, the fact that you've wrote a book specifically for this industry is incredibly helpful. So John, thank you so much for joining me on the show again.
Yeah, thanks for having me. I really appreciate it.
And to everyone listening, to find the blog post for this episode and download 10 ways to get new clients for your hit business, please go to highintensitybusiness.com, search for episode 295. And until next time, thank you very much for listening.